In a slow growth environment like this one, the one where companies are handing cash back to shareholders, it does pay to have a macro view. That's why Erik Upin is here. He is a partner and chief investment officer of Makena Capital, where he helps to manage $15 billion for endowments, sovereign wealth funds, and foundations. Erik is the former CEO of Sequoia Capital and also the former chief investor for Stanford University's endowment, and he is back on the inside track. So, Erik, why don't we start off with your macro view? Not everybody feels the same about the future of the global economy and the future of financial markets. What do you think is going to happen?
Well, I think the big picture is four titanic forces at work in a Roman Colosseum gladiator battle, and those forces are...
That's a good image.
The first is the forces of delevering, the forces of a debt cycle wind down. Whether mild or severe, only time will tell, but that may be the primary trend. That generally is low growth and real challenges to asset prices. Against that very powerful primary trend are the forces of emerging markets, which are growing, where GDP per capita is rising, where demand for commodities and energy is increasing, and that's a growth force. And the third powerful force is the forces of fiscal response, Fed policy, intervention. The U.S. is already borrowing 40 cents on every dollar it spends. We have substantial stimulative efforts at work. We have applied the most amount of stimulus dollars and efforts and policy response with the weakest recovery ever observed. And then lastly, there are natural healing and corrective forces in the market. So those four forces are going to show different signs of winning in this titanic battle. So at times we'll see contractionary forces, low growth like we've seen this year. Times there will be inflationary forces, times where policy response is working, times where more is needed. That creates a more volatile market.
But no clear winner among these four titans?
I think we'll see bits of all of them, and it is almost too big a bet in our view if you're trying to manage a portfolio over a long horizon to be overly anchored on one. But it does require you to have views on these and position the portfolio accordingly.
But how are you managing risk, let's say? How you perceive risk with these four forces now, let's say, different than how you saw things a year ago?
Well, I think the big difference is that the developed world growth is slowing. And secondly, what we've been seeing, but only more so, is that after all the policy response, this is a substantially weaker recovery than we've seen in the past, and a substantially bigger hit to the economy with '08 still lingering, with decades of leverage and debt buildup. So we're really dealing with a problem that's been built up over decades. To answer your question on risk, one is to operate a portfolio with less risk. In our view, a portfolio with more hedge fund and absolute return strategies that give more flexibility and volatility reduction, greater emphasis on natural resources, greater emphasis on big global stocks, and maybe reevaluating what is risky. In the past, I think a European sovereign bond was viewed as a risk-free asset. We may be living in a world where a Nestle may be a less risky investment than certain European bonds.
Erik, we first met in the incipient stages of the European sovereign debt crisis. Things have clearly deteriorated since then. Just how much of a danger does the situation in Europe pose right now in your mind?
Well, I think there are two big dangers. The first is it's a serious problem, and what's the problem is too much debt. Much like when you look at '08, we had too much real estate debt and leverage. We had too much financial system debt and leverage. But it was really the real estate being Mrs. O'Leary's cow that set Chicago fire, which was the banking system. So the European issue we see is substantial amount of debt, banks buying what they thought were risk-free assets, even though they were paying more than German bonds. They bought a lot of periphery debt. Now banks levered 20 or 30 to 1, and it's hard to know exactly what degree of leverage means you have a banking problem. And if you have even a 4 or 5% haircut when you're levered at 20 times to 1, that's a severe balance sheet hit.
Are you banking on a banking crisis in Europe?
No, but it is in a list of risks. I think the big picture is when you look at your list of risks, even versus 2007, I would argue the risk is longer and with broader implications. And then the second problem with Europe is it's not just a tough problem today, meaning if you just wrote a big check and bailed everyone out, you'd be fine. Because economies are slowing, we have revenue slowing, costs going up, so the debt continues to grow. Even if you could ameliorate today's problem, you then have tomorrow's problem as it comes back.
Sounds awfully like the problem we've got here. Erik, always great to see you. Thanks so much, Erik Upin of Makena.